Welcome to Cheques and Balances. I'm Michael Vincent. This is James Blair. And this week, the responsible lending code changes.
Well, Michael, as Counting Crows say, you don't know what you got till it's gone. It feels good to be back.
It does.
It feels to be good to be by your side, toast behind the camera, the sign lit up. It feels like one of those things where, you know, Zooming was nice, but I'm sure the quality of the audio is going to be bang on today, and it's nice to be talking about none other than lending requirements.
I know, what a punchy subject for our first episode back in the studio.
Yeah, I like how you call our office the studio.
Yeah.
So we thought this was a really important topic and something that is creeping up quite quickly that a lot of people probably aren't aware of, and the changes to essentially how your expenses, how the bank measures your expenses, and what is going to happen, what are the dates.
Yeah.
So Mike, you are Mr. Money Man. I'm of course Stat Man for
Yep.
those that have forgotten.
Legal money, Mike.
Yeah, if you don't know now, you know. What are the changes? When are things coming? And maybe what might be best as well is going, how does the world work at the moment?
Yeah, cool. So these changes are off the back of some legislation changes. That legislation is the CCCFA, or Credit Contracts Consumer Finance Act. I got it.
I am so proud of you.
Thank you. But what's really changing off the back of that is the responsible lending code. Why is it changing? Well, the government is trying to, I guess, in my opinion, fix a problem that isn't really there. But what they're trying to do is sort of control cowboy lenders, or credit facilities that are sort of on the fringe a bit, and make lenders and banks take a bit more accountability and look at things in a bit more detail when they're lending out money. Like I sort of said, I don't think it's a problem that's actually there in the market anyway.
It does not surprise me that the mortgage guy is saying that there's no problem with too much lending in the market.
It's not too much lending, right? And I think what I'm sort of talking about here is, I'm not saying that loan sharks or payday loans and these sorts of things shouldn't be reined in a little bit, because that's always the case. But there was a need for those like payday lenders and that sort of thing. But when you're looking at bank lending and the amount of defaults and all these sorts of things, I just simply don't think that the problem is there already. But they've changed it, so the market has to adjust. Really, the big things that are changing in the responsible lending code that are going to impact consumers and how much they can borrow well, the first piece is specific inquiries about the purpose of the borrowing, and the time that you're going to pay it back, and the amount, and these sorts of things. And the second thing is specific inquiries related to the customer's ability to afford the lending, and their expenses, and the likelihood of them suffering financial hardship. So I'll start with the first one, which is the inquiries about the purpose of the lending. So TLDR, what does this mean? You're going to have to answer more questions in the lending application around what do you want the money for, how much do you want, what period of time you're going to pay it back over, all of these sorts of things. It's not like banks don't ask that already, but generally speaking, you give them an answer, they kind of accept it, and that's it. Now it's going to be like, okay, so let's say, Mike, you can pay this loan back in 20 years, but you're asking for it over 30 years. Do you completely understand the implications of that? Or let's say I'm refinancing and my loan is at 25 years, but I'm pushing it out to 30 years again. What are the implications of that to you in a dollar basis and a cost basis, and how much more interest are you going to be paying over time? So it's really specific questions around that that you will have to prove to the lenders that you've talked about and that you understand.
That's very interesting. I actually didn't know that. I thought we were going to have much more of a discussion around the expense side. But
we will, but there are two bits to this that are going to impact customers.
Yeah.
This part is important to cover off, because it's not just how much can I borrow, right? Yeah. And that is the primary focus for a lot of people. But it's what are the conditions? What are the products you've got? If you've got a revolving credit facility now, do you understand the implications of that revolving credit facility over the long term in terms of interest costs and these sorts of things?
So if I'm 30 and I've got $1 million mortgage, the idea of repaying the mortgage, I would just be thinking is, well, I've got a term loan for that 30 years, I'll repay it over that 30 years. But is what you're saying is changing, is instead of just going, here's the money, going, hey, you've got a strong income, you've actually potentially got the ability to pay that down over 20 or 25 years instead of 30. Is that the kind of conversation? Will we have the additional interest?
It's more around, potentially. It's more around probably, in that specific example, more around the refinance option there. Because a lot of people kick it back out to 30 years to refinance because then you can borrow more money somewhere else and these sorts of things. If you have the ability to pay it off in 25 years, you're probably not at your max borrowing capacity at the start of that loan. If your financial position has changed, your broker should be talking to you about these sorts of things. So that may come into play, but generally speaking, for the example around the terms, it's probably more relevant to when people are refinancing or when people are extending loans so they can borrow more money. If I'm getting an investment property and I got 15 years left on this loan as the minimum repayment, kick it back out to 30 years, all of a sudden I can borrow a lot more somewhere else.
Okay, and then how about the example of, say, a 55-year-old getting an investment property with a term of a loan going past when they're going to stop working?
Yeah.
Does that conversation become, is I'm just going to sell the property at some point still good enough, or does that change?
Yeah, look, so once upon a time that really didn't matter at all. That would just be have the loan, have the money, see it later, forget about it. But actually, banks already, and this is why I don't think the problem's really there, banks already are pretty clued up on that. Well, I'll ask you about what the exit strategy is. And absolutely now there is more scrutiny on that exit strategy, right? So it's not just, hey, we'll sell a property, bish, bash, bosh, doesn't matter. There's a bit more scrutiny from the banks around what is that exit strategy, what happens if it goes wrong, and what are the actual numbers behind that,
Okay, but if I buy an investment property and say I'm going to sell it in retirement, is that still a good enough answer, or is it going to be?
It is still a good enough answer, but they probably need a little bit more detail around that, right? And here's where the detail comes in and the extra questions. When do you plan on retiring? What are you earning up until retirement? All of these sorts of things. That's a bit more of what we do now, which is just that, we're going to sell it at retirement. Now it's going to be, okay, when does the customer want to retire? Do they understand the implications? What happens if they can't sell it? What happens if the market is down? All these sorts of things. So it's just more detail on everything around the purpose, the repayments, and showing that the customer understands it.
Great. Okay. Well, that's quite interesting for those that are maybe taking on debt a little bit later in their working life. And it sounds like the other one that's going to have a big impact is when you change banks. Instead of just pushing out the loan, there'll be a bit more of a discussion around, is that the right thing for you?
Yep, absolutely.
Now, on the expense side, Michael, on that kind of second part of the two big changes, can you talk us through that a bit?
Yeah, cool. So currently as it stands with the banks, there are benchmark expenses. So what that means is that when you go to the banker can say, what are your average expenses? And you'll give them the expenses. They'll probably do some checks to make sure that they are reasonably accurate. But what they also might do is use benchmark expenses. So let's say we're a couple, we have a child, we earn $160,000.
Let's say.
This
relationship is nothing.
We are each other's bubbles, let's be honest. Let's say we're a couple, one child, we earn $160K per year. That benchmark expense is probably somewhere around $2,700 per month. That doesn't include things like rent, additional debt repayments, credit cards, these sorts of things. That's just the stock standard. What do we need to survive for that month? Let's say we're a single on $80,000 per annum. You're probably around $1,500 in that benchmark expense per month. So what happens is the bank at the moment has a lot more ability to lean on those benchmark expenses without doing actual checks or really detailed checks on what are the expenses going out of your accounts. That is all changing. Now, if in the new world, under the new rules at the end of the year, and to be fair, they're meant to come into force in December, or they were meant to come in October, now they're coming in December. We're pretty much operating under them already anyway, so it's too late for anyone trying to get in beforehand. If I have a really high expense rate, so let's say you and I are out every night at going out for dinner, all of these sorts of things, just have a really high expense rate. The bank now will have to go through and line by line look at the bank statements and go, actually, that $2,700 a month, forget about that. You know, they're closer to $5,000, and it's now a lot more difficult to argue that actually we have a lower expense, benchmark expense than our actual expense. So now it's going to be that's in most cases, in most instances, meaning that people will be able to borrow less money because their expenses will be higher.
Yeah. Do you think this will have you've made it clear on your views, which we don't need to get into anymore.
It's a problem that wasn't there that's been fixed.
Yes, you've alluded to that just a little bit. Do you think this will have a material impact on people going forward? Like, for example, are the benchmarks used at the moment reflective of the average person's household expenses?
They're probably a little bit low, if I'm honest. Generally speaking, people's household expenses are probably a little bit higher. Where this might start to get a little bit tricky is, let's say I'm a first home buyer, right? And we see this quite a bit. And at the moment we go to the bank and we go, I know they're at the pub every night. I know they go out for dinner with their friends, but don't trust me.
Toast is going to change.
Yeah, as soon as he gets a house, it's going to rein all of those expenses back in. And reasonably speaking, at the moment, the bank can be like, yeah, okay, that kind of makes sense, that's fine. Now, the bank is far more likely to say, no, actually, we need to evidence, if we get audited, that this is the customer's actual expenses.
Yeah.
I'm not taking into account rent here because your rent will go away, you'll pay the mortgage instead. But they are well within their rights now to turn around and say, actually, no, the customer's expenses are right up here, and they need to pull them back into line before we're going to give them their give them that loan.
Sorry, Toast, the leopard can't change its spots.
So, I guess the advice there for customers is, if you're a first-home buyer or if you're thinking about applying for lending, start to trim those sort of expenses early on, especially if it's things like going out and stuff, luxury items and these sorts of things.
Well, lockdown might been a good chance to do that. I guess a really obvious question, Mike, is how long of a history do I need to show that I've changed, that those spots can change?
It depends what bank you're with, whether it's your main bank or a new bank. Generally speaking, you're going to need about 3 months worth of bank statements.
Okay.
But just keep in mind that 3 months is probably a decent period. But if you're at your main bank, they've got all of your banking history. They're not going to go that far back, but it is just something to keep in mind that your bank can go back further if they want to, if you're their main bank.
Yeah, and I guess a couple other points that I'm thinking about. One is first home buyers seem to get excluded from a lot of these rules, despite it being right or wrong to level the playing field. Does this apply to first home buyers like any other person trying to get a mortgage? Yes,
this is not. There are circumstances in the legislation where triple CFA doesn't apply. If it's not retail lending, triple CFA doesn't apply. There's some other instances which are probably pretty technical for the bank, like if it is extremely evident that the customer will be able to pay this back without suffering financial hardship, then there's some triple CFA that doesn't apply. But generally speaking, for 99.9% of customers, this is going to apply. And even if you are a first home buyer, a next home buyer, and investment property, these sorts of things, all of this is going to apply.
Yep. And then the other thing I think about with my banking history is there must be some tech behind this which the bank will be battling to try and get right, or are they manually checking bank statements?
Well, you are seeing this overseas. There's a lot of tech being invested in this space. But for the moment, it's probably going to be a bit of manual work because we know...
Love it.
You and I know how banks operate and the tech that they're trying to work with, the legacy technology from the 80s that they're still trying to pull DOS into this century.
I was just thinking DOS as well.
Yeah. For a while it's going to be pretty manual. But no doubt the banks, because this will be, you think about the length of time that it takes someone to do this, that's quite a large increase in cost on a mortgage application. There'll be a lot of tech going into this space.
Yeah. Great, okay. So this is a topic that is going to impact a lot of people when that legislation does hit. Maybe it's the end of the year, maybe it's coming into next year. But what we really wanted to do in this episode is if you are looking for lending now, whether you're a first home buyer, upgrading, or investor, the conversations you've had historically with your broker or bank, they probably, if they haven't happened for a while, or they haven't had a discussion with that lens over them, you're going to need to talk about them again and make sure that that the amount of lending or your expectations can still get met. If the answer is no, then you're going to have to look at the expenses and what needs to change going forward.
Or adjusting your expectations on how much you can borrow.
Yeah.
That is another really key thing here.
Great. Okay. We're going to wrap it up there. Thank you very much for joining us. Make sure to give us a subscribe on YouTube. Give us a like if you're on Apple. We hope you're enjoying. If those listening on podcasts are enjoying the better audio. Now we're back off Zoom. And we'll see you next week.
Cheers.